There is a powerfully persuasive body of research showing that the average fund manager doesn't beat the market. It's very difficult to identify genuine outperformance, and even harder to predict it in the future. The Dalbar study in the US also shows that many investors manage to buy and sell at the wrong time, and thus even underperform their own investments. If you buy into the argument for passive investing, which can range from the reasons above to simply preferring to spend more time enjoying yourself and less time studying shares and funds, then you have two choices. Lars Kroijer, a leading UK proponent of passive investing, joined me on the Investing Show a few weeks ago to his case for simple investing and the easiest route into it. The global shares are the riskier bit that should deliver better returns over time due to companies' ability to generate profits and pay dividends, while the high-quality bonds are the safe asset for when the bad times come. You mix the two elements according to how much risk you want to take. The problem is that, while it likes to promote its simplicity, passive investing can be confusing and acronym-heavy. It's no wonder people prefer active funds that describe better what they do. What you are looking for is a combination of the right index, accuracy tracking it, and low costs. There are a couple of global stock market indices, and while broadly similar, they do differ slightly. Unfortunately, they tend to have names full of acronyms rather than describing what they do. These index funds will follow their named index. Visit the fund provider's page and look for the breakdown of the index, which should explain exactly where it invests. This issuer's ETF invests in developed country companies around the globe and is based on the MSCI World Index, of which the biggest holdings are 59% in the US, 8.8% in Japan, and 6.4% in the UK. So with this ETF you also get exposure to countries such as Brazil, Mexico, Poland, China, and India. The biggest holdings are still the US, 53%, Japan, 7.8%, and UK, 5.6%, but China slots in fourth place with 3.44%. It has ongoing charges of 0.6% and is listed as SSAC. This is an index fund that tracks the FTSE World excluding UK index. It has 55% in the US, 18.5% in developed Europe, 9.4% in Japan, and 4.2% in emerging Asia. Bear in mind it does not include the UK, so it's better for those who already hold UK-focused funds or shares elsewhere. It has ongoing charges of 0.08%. This is an index fund that tracks the FTSE Global All-Cap Index made up of large, medium and smaller company shares in developed and emerging markets. It has ongoing charges of 0.24%. The biggest holdings are North America at 49%, developed Europe excluding the UK at 16%, Japan at 8%, emerging Asia at 6.3%, and the UK at 5.8%. This is an ETF that seeks to provide returns consistent with the performance of the Bloomberg Barclays Sterling Gilt Index. Government float adjusted bond index.It has ongoing charges of 0.15%.